All right, we are back with some tariff updates. Then we'll dig into inventory this week and give everyone a clear indication of where we believe the market is heading. So, past two weekly market updates, we've been heavily covering the tariff news. And just so everyone knows how difficult it can be being a loan originator, last week we had the highest increase in 10-year treasuries in over 40 years. Since 1981, the 10-year treasury increased over 50 basis points. And for those who don't know, the 10-year treasury directly correlates to mortgage interest rates. So mortgage interest rates raised over 0.5% in 5 business days. We were quoting 6.6, and then next thing you know, you're quoting 7.1%, literally 5 days later. So it is difficult. Yes, you can imagine, obviously, being a loan officer. You can imagine being a real estate agent. You can imagine anyone in the industry. And of course, you can imagine being a borrower, right? Getting a quote, thinking this is going to be your payment on a home. And then just like that, your payment is up $200, $300. Difficult week for mortgage. That being said, it was the initial shock. It was the initial fear and uncertainty. We needed that to stabilize, and it did, right? So now that it is stabilized, we have seen a small regression back to the mean. So interest rates have fallen about 0.25%. Again, we're still up from where we were about 7 days ago, but that initial shock is gone, and the market will continue to stabilize. In reality, I want to just cover tariffs again a little bit more real quick. I want to highlight, again, the delivery of the administration has just been quite poor, which is probably leading to this shock. I mean, also, let's call a spade a spade. The markets have clearly said they do not like the tariffs. Again, whether your opinion, whatever your opinion about it is, I'm a person on, I want to aggregate all of the data. The markets, whether it's the bond market, whether it's the stock market, both markets have clearly said they are not fans of this tariff trade war, possibly with China. But in reality, again, the delivery has been quite poor. The best way, the delivery that should have come out is, hey, why do we want to do tariffs? Why do we want to reshore? Why do we want to bring back manufacturing to the United States? Well, simple. We just had a pandemic 5 years ago. And everyone knows during that pandemic, or 4 years ago, during that pandemic, we saw massive supply chain issues. We were super reliant on other countries. And of course, other countries are reliant on so many other countries. It's been the globalization. We've seen that over the course of the last 30 to 40 years. And we're trying to now mitigate some of that globalization. Hey, let's bring back some of the most important items that if something like this ever happened again, then guess what? We are now reliant on ourselves. That delivery, that way to express to everyone, this is the reason, this is the foundation behind it, guess what? That probably goes over so much well. The markets probably react a lot better, but just the mass abruptness of what we're doing, the sheer amount we're doing it at, obviously is not what it is. And of course, the administration can have ulterior motives, right? Reshoring, bringing down the 10-year treasury, eliminating income tax, again, not going to happen, things like that. So we don't know the true motives, but we know, again, that delivery would have certainly helped. Again, why is the market stabilized? Well, we've seen major things. Obviously, a week ago today, we saw a 90-day pause from all other countries with the exception of China. With China, we've already seen specific carve-outs, right? We saw some electronic good carve-outs where we're not going to charge 145% tax. We're only going to be charging a 10, 20% tax on this. I believe the way this plays out, because a lot of people ask me, when do I think this tariff trade war is going to end? I truly have no idea. I believe the market will continue to stabilize. I believe the initial reaction is gone. I believe we'll continue to see more carve-outs. We'll continue to see more agreements, right? There are certain goods that do matter. China does have raw materials. China does have some farm IP. They do have some items that we do need. Those carve-outs will continue to happen, and the trade war will continue to subside, the dramatic effect of it. But obviously, that's just an opinion. Obviously, we'll have to wait and see how the administration plays this out. But overall, stability is what we need. Just we can't have initial crazy tweets that have the ability to move markets quite heavily. So now we'll go on to inventory. And if you haven't been following us, I believe inventory is absolutely the key to the market. We saw inventory increase again, and we're up over 33% year over year. So if you take this math, if we're up 33% year over year, and if you look at the amount of single-family homes that were available to sell at the beginning of the year, 635, and you multiply that by 1.33%, because that's what we're currently above, guess what? That gets us 840,000 single-family homes available for sale. That's great. That is above 2019 levels. We have finally hit our equilibrium again, or we are on pace for equilibrium. So right now we're on pace for Q4 equilibrium with inventory. As we've discussed, as soon as inventory get back to normal levels, prices subside, becomes more of a buyer's market. Guess what? This theoretically moves interest rates lower. Everyone continue to be patient. We are continuing to trend in the right direction when it comes to real estate and mortgage. We're almost there. We're in this last inning stretch. So again, if you have any questions, feel free to reach out.